Two reports came out this week that look contradictory on the surface. And if you only read the headlines, you're going to be drawing the wrong conclusion about where this market is headed. I'm Robert with Open Lane Funding, and let's get into what's actually happened because the details matter more than the top numbers. Let's start with the mortgage applications. The Mortgage Bankers Association weekly survey covering the week ending in August 14th and released August 19th showed that applications were down 0.4% from the prior week. That reverses the 3.6% surge reported the week before, which is now looking like a 1 week bounce rather than the start of a durable rebound. The 30-year fixed rate on MBA's own survey also ticked up slightly to 6.69% during that week. Here is the detail worth pulling out. Average loan size actually rose to 282,200 even as overall application volume slipped. That combination tells you something specific. The buyers still transacting are trending toward the higher price points, not that broad-based demand is strengthening. The lower budget buyers appear to be the ones stepping back first when rates start ticking up even slightly, while those higher leveraged investments and move-up buyers keep transacting regardless. Here's the interrupt pattern, because this is where most coverage starts getting it wrong. You'd think a slight rate uptick paired with the falling applications is straightforwardly bad news across the board. But rising average loan size and a falling volume week usually signals a segmentation shift, not a demand collapse. If you're structuring debt service coverage ratio loans for investment purchases, and that upper price band this week's data does not point to a weakening demand in your segment. It actually points to the opposite. Now let's move to the labor side, because this is where the real story is. Weekly jobless claims for the week ending in August 15th, released August 20th, fell to 206,000, down from a revised 212 from the week before. That revised figure matters. The original August 8th print was 209,000, later revised up to 212,000, and this week it's back to 206,000, which came in below the 210 consensus estimate. Now, on the surface, that's a clean beat, but here's why that logic breaks down if you stop reading there. The 4-week moving average, which smooths out weekly noise, rose to 204,000 from 199,750. And continuing claims actually climbed to roughly 1.8 million, and the highest level of the current stretch we're tracking. This divergence is the signal that actually matters. An improving headline number against a rising 4-week average and continuing claims tells you layoffs remain sparse. Employers are not aggressively cutting headcount right now, but it is taking longer for people to lose a job, who lose a job, to find the next one. That is the labor market cooling gradually from the reemployment side, not from the layoff side. And that distinction is exactly what the Federal Reserve will be parsing heading into their next rate decision. That is a good time to hit that subscribe button if this kind of week over week data breakdown is useful to you. I put these in multiple times a week, and if you're trying to time the right purchase, refinance, or a DSCR acquisition against a market that's sending mixed signals, depending upon which data point you look at, you're going to want to be on this feed before that next report drops. So, what does an investor do with this information this week? If you're underwriting a deal in the upper price band right now, the loan size data suggests you're not fighting against a falling demand in your segment. You are competing against a smaller pool of more qualified and more committed buyers. That's a different competitive dynamic than a shrinking market overall. On the labor side, if you're running numbers on the rental property in a market with the local employment exposure, the rising continuing claims trend is worth watching over the next several reports, not reacting to on 1 week's data alone. Now, one print doesn't make a trend. 3 or 4 consecutive prints in the same direction, that's going to. Now, right here in the inland Northwest, Spokane and Coeur d'Alene, behind these numbers, or Spokane and Coeur d'Alene investors should be watching whether the local employers show any early signs of reemployment slowdown, showing up nationally. That's not confirmed locally yet, but it is kind of leading it. But it's the kind of leading indicator worth tracking before it shows up in the local sales data. And if you want actual loan scenarios and deal structures behind all these numbers, make sure you book that call at openlanefunding.com. And if you're evaluating a purchase right now and you want to know how the current lender indicators on a rate or loan sizing apply to your specific deal, that conversation starts there too. I'll see everybody there next week on Monday with the next round of data. I appreciate you guys. Have a great one.